Hey everybody, I'm Joshua Brustein. I'm a writer for Bloomberg Technology. For the next 30 minutes or so, we are going to talk about token sales and ICOs as a form of crowdfunding. We have a panel of experts to talk about it. Closest to me is Shidan Gouran of the Global Blockchain Technologies, an investment firm that looks at blockchain businesses. We have Georgia Quinn of CoinList, which is a platform for token sales. And we have Perianne Boring, who is the president and founder of the Chamber of Digital Commerce, which is a trade group for the blockchain industry. So Perianne, I wanted to start with you to kind of set the stage a little bit. You recently released a set of guidelines for kind of best practices for token sales. And I just want to read the definition you gave for tokens, because I think this kind of gets at sort of what we're going to be talking about a little bit. You wrote, "A digital token can be a security, a currency, a commodity, property, or even a hybrid of those characteristics." Now, it seems like that flexibility is sort of contains within it the potential of this kind of crowdfunding and also some of the complications that come with it. So I was wondering if you could just parse that definition for us a little bit and tell me kind of like where the what are the good parts and what are the parts that are going to maybe trip people up there.
Yeah, sure. So blockchain technology allows for tremendous amounts of flexibility for digital assets or crypto assets or tokens, kind of depending on your preference of the term.
Sure.
The report that you referenced is called Understanding Digital Tokens, and part of it is educational to inform the policy community plus the broader industry about laws and regulations impacting digital tokens. And then part of it is also our guidelines. So we worked with the industry. We brought together over 400 stakeholders globally to agree on principles for what we call non-security tokens, or sometimes they're referred as utility tokens. Tokens, depending on how they're used, can have a range of different functions. And when we're speaking with policymakers, our motto is always regulate by function on how the technology is being used. So we have seen use cases where tokens are considered a currency or a cryptocurrency, like Bitcoin, or it could be a security. So there's this whole new wave of security tokens. They can also be a commodity. So the CFTC, the Commodity Futures Trading Commission, has determined that Bitcoin and digital assets are a commodity under the CEA. And then you also have FinCEN, who regulates money laundering, who issued guidance in 2013, so 5 years ago, who has said convertible virtual currencies will be regulated like currency. The IRS, which is also part of Treasury, just like FinCEN, has determined that they'll be taxed as property. And then you, of course, have the SEC that's looking at this through the lens of a security. So it's about as clear as mud in terms of how to navigate through this for startups. We're really at the ground floor of really determining what laws and regulations will apply to blockchain. But again, we encourage you to look at it as function. What was the purpose of this project? What are those tokens supposed to do? And applying regulatory frameworks with that concept in mind.
Sure. And so I think what we saw over the last 2 years or so was things like the development of these tokens were happening. Not many people were paying attention, at least relatively. And then all of a sudden there was this huge boom, not only in Bitcoin, but in ICOs, initial coin offerings.
Right.
I'd love to hear from you guys just kind of like, what happened over the last 2 years? I mean, my head's been spinning as someone who's been covering it from the periphery, but it did just seem to come out like a rocket ship out of nowhere.
Yeah, I mean, I can kind of take the lead and then let you guys jump in. But really, and I think it's important that we're actually at this crowdfunding conference because the genesis of all of this really came from crowdfunding. If there hadn't been this concept of online capital raising, we never would have had this boom in ICOs and the development of this industry. So that was really the ground floor. And utilizing that methodology, a lot of issuers and project developers realized that they could raise a lot of money very quickly with the promise of this, blockchain technology. And simply by calling something that was most likely a security a coin or a token, they felt that they wouldn't have to adhere to securities laws of any country. And what we found out is that was really not appropriate and not the case. And so, we had this huge frothy period where everyone wanted to get involved, and these ICOs seemed like this very glamorous, exciting thing. And then, the commissioner, SEC commissioner, came out and said that actually there had not been an ICO that he had seen that had not been an offering of securities and thus was an illegal offering. And so now we've seen that market dry up to a large extent. And we were talking about this before. There are a lot of different takes you can have on is this a good thing, is this a bad thing. At CoinList, we really think this is a positive thing because it's created a flight to quality, and the cream is really rising to the top. And frankly, there were a lot of really bad deals out there over the past couple of years that we wouldn't want to be associated with or be a part of, and those are really falling to the wayside. And now we're seeing much more legitimate deals that are utilizing this technology in really exciting and innovative ways, rising to the top and able to access that capital now.
Yeah, I would absolutely agree with those comments. So we really outlined the history of ICOs in that paper. It was released on GitHub, so it's a free resource that you guys are all welcome to look to. So we saw some early token offerings, or ICOs, starting as early as 2013. With Mastercoin, and there were a few. And this concept of raising money using blockchain technology was tested over a couple of years. It wasn't until about 24 months ago that we saw this huge spike in ICOs, upwards of $5 billion raised through ICOs in a very short amount of time. Just the concept really took off. And then, as Georgia mentioned, there was absolutely fraudulent activity. There were scams. Like any new technology, this is not unique to blockchain. There were bad actors that were coming in, abusing this for nefarious purposes. And that was the whole point of putting the Token Alliance together, is in the absence of having regulatory clarity, we wanted to bring the good actors together to have something on paper that says, here's how you delineate the garbage from the good. And those guidelines are really meant to be used as a resource and a point of reference to how to be able to determine a scam from a real project. But as Georgia also mentioned, Filecoin, it is not about avoiding regulation. It's about making sure you have the appropriate regulatory approach that takes into account the unique attributes of blockchains. We don't want to stifle it and call it something that it's not, so it doesn't have the opportunity to grow into a new piece of technology. So Filecoin is a good example of a token that should not be considered a security. Even the CFTC Commissioner Brian Quintenz even said in a speech that he believed Filecoin would not be a security. It should be outside of securities laws. It's a utility token. So there are good and legitimate projects. We've seen a huge slowdown because we've seen many enforcement actions over the SEC just over the recent past, which has sent a sign to the market of the laws do apply. They apply to you. And if you don't follow them,
no matter what you call it.
Right. It doesn't matter what you want to call it. And they are looking at this space. And so, I would agree with what you said. What we've seen is a lot of the garbage has left. Yep. They don't want to go to jail. And what we've been left with are real quality projects that deserve to be here and deserve to have the opportunity to grow and go to market. But we have been successful in rooting out a lot of the scams.
So I just want to add to that. So I think, from 2013 to 2017, the heyday of these ICOs, for every successful project, people don't talk about the other 100 projects that weren't successful and didn't raise a lot of money. In fact, in my opinion, most of the ICOs haven't done better than pink sheets, and they're not any better or worse as far as being legitimate or not than most of the lower end of the capital markets. The reason some of these projects like Filecoin, why they raise so much money, is because they came out with the promise of totally changing the business model, taking what are platforms today, using blockchain technology to turn those platforms into a commons, where the tragedy of commons, that problem has been solved through the technology of blockchain. So people were very, very enthusiastic. They invested a lot in this space. And there's now a certain amount of fatigue because people are like, okay, we've now invested a lot. We're very excited. We put hundreds of millions into these projects. Now we're waiting to see if they can deliver on it. And so those projects rightfully deserve that kind of reaction because they were looking to solve a very fundamental problem with society and business and whatnot, and it'd be a real advancement in technology. And that's one thing to keep in mind, that these projects have promised a lot. they excited people a lot. And now that we're in the trial of disillusionment, it's because people are like, okay, what comes now? Let's see if anybody can actually deliver on anything. And I think if people expect to be able to raise the kind of money that some of those projects like Filecoin, and a few others that I was myself involved with, to raise that kind of money is not really realistic today. I think it's not going to happen, and I think token funding is no different than crowdfunding. It's no easier, it's no harder. It doesn't get rid of middlemen because a lot of those middlemen aren't really middlemen. They're service providers. If you're a business, you don't necessarily know how to market to investors. You don't necessarily know how to build a book, or you're not an investment bank. You still need those service providers. And blockchains don't get rid of those intermediaries because that's a skill. That's something you develop over time, and it's not everybody's job. Their job is to run their business, whatever it is. Yeah.
So that brings up an interesting point, because right before we saw this huge boom in ICOs, there was a lot of talk about equity crowdfunding. There was federal legislation. There was a lot of excitement that this was going to be kind of the democratizing way for companies to raise money outside of the traditional VC ecosystem and so on. What did that lack that blockchain-based crowdfunding and ICOs and so on managed to come in and offer?
Yeah, I mean, I think it's twofold. One is crowdfunding is still highly regulated. I mean, crowdfunding is still, there's a registration process with the SEC. It has to be conducted on an SEC-registered funding portal. So there are a lot of hoops and hurdles that have to be jumped through.
Caps.
And exactly, there's investor caps. There's total raise caps. You can only raise $1,070,000 now. So there's a lot of issues with equity crowdfunding as it stands today. The people who were doing ICOs were not abiding by any laws. They just were raising as much money as they could on the internet as quickly as possible. So that's why it was able to take off. They didn't adhere to any regulations or requirements.
So is this like the traditional tech story that you go ahead and break all the rules until someone pays attention, until you get big enough that people start paying attention to you, and then you go back and say, okay, tell us what rules we need to abide by?
I think this is you guys laugh, but I think this is a fundamental issue in entrepreneurship today. I think the big models that we see are Uber and Airbnb, who made a habit of asking for permission or asking for forgiveness and not permission. And so that is now part of the culture of startups and part of the culture of entrepreneurship, which is, break all the laws until I get caught, or break all the laws until somebody gets hurt. And that is an issue, and we need to rethink. I mean, is this a byproduct of the regulatory state and that we have too many rules to even be able to comply, so why try? Or something else? I don't know, but I mean, we're getting a little off topic, sorry. But I mean, I do think that this was the ethos of that whole ICO froth.
But it seems like maybe the point in that froth that we've reached is let's go ask for permission now that they've noticed us.
Well, after, about 100 enforcement actions and the SEC dropping subpoenas on everyone, I think people got religion.
Sure.
90% of ICOs, the only people that made money were the lawyers. And you say lawyers,
Seems like a mature business.
Lawyers are the worst.
Because,
I'm a lawyer, it's okay.
People didn't, it wasn't a matter of registering. Most people didn't want to do it in North America because they were, worried about this thing called a token. It'd be tradable after and everything. And it's ridiculous the amounts of money they spent on legal and all the other services that I mentioned, all the other intermediaries. That's actually where most of the money of these failed ICOs went. And it's, failed ICOs is here, who might have spent $400,000, $500,000 to try to do an ICO, and successful ICOs is here, right? And even the successful ones, people think that it was the retail crowd that invested in them. That's not the case. 90% of these were mostly funded by sophisticated investors, very early people in the stage, VCs in the valley. Even Filecoin, for example, I think the first 52 million was pretty much very local.
Filecoin was all accredited investors.
All accredited, but even more than that, the first 52 million I think was the cream of the crop in the valley, right? Yeah. And that's really what happened with these tokens more than anything. So it's not as easy as people think it is. It's not any easier than raising money through a Reg A plus offering. Last year, I remember I saw this Reg A offering that was Yayo, I think it was. And I was looking at it. To me, it looked like an ICO. It was a website. You had this video of maybe not Evander Holyfield, but it was the Seinfeld guy.
Yeah.
And
Mr. Peterman.
Mr. Peterman, and it was pretty vague as far as what they're offering and everything, and they raised a lot of money. So you know, they're one of many dozens of companies that try to do a proper Reg A plus that weren't successful, right? So that's one thing to keep in mind. It's not as easy as people think it is.
There's kind of two different ways that I would look at a token offering. If you are issuing a token, or a project is issuing a token to raise money so they can build something, that looks a lot like a security. If they are issuing a token that is grants you access to a software program that is already built, that doesn't look like a security. And so if they're using this tool to raise money, then it's very easy to make the argument that that is a regulated process and we need investor and consumer protections through that. What we want to protect are for those companies that are issuing tokens that allow for access to a software program. That's kind of the way that we've kind of differentiated the way that we look at token projects. And so that's where, to your point on security token offerings, that's now why we're starting to see this idea of STOs, or security token offerings, where they're issuing a security to raise money to build something. And that token may or may not operate within the software program that will be built at a later date.
And that functions basically like equity in this case.
It can be.
Rev share, equity.
And kind of going back to your original question of, well, why not just use traditional crowdfunding? What's the point of a security token? It's the difference is it's being issued on a blockchain. So you have that distributed ledger. So then those tokens will be connected to that blockchain, and they will likely serve some type of function in some type of platform. And there's a lot of different types of security token offerings, but they have a function within a system. It's not just a piece of paper that says you have this many shares in the company.
Right. And I'm sorry, go ahead.
Sorry, yeah, just one thing I wanted to add, and just what Perianne said reminded me of this. There is one huge advantage of ICOs and security token offerings and all of this over traditional crowdfunding, even online funding, and that's the banking and the fundraising is done in cryptocurrencies. So what that means is, and I mentioned this to you before, I think, some engineer in Shenzhen who makes 120K a year, he can't necessarily come here and open up a bank account and get a broker and all that kind of stuff. You need to be considerably more rich than that to be able to do that in North America. But he can easily send some Bitcoin and do a quick KYC AML process and invest in a North American company or North American real estate. You have a huge, it does make the world smaller. It's not because it makes the financial industry, like the securities industry, more efficient. It's because it makes the commercial banking world more efficient because you don't really need them necessarily, right? You can raise money without them, and that reduces costs a lot. If you're a cannabis company and you want to raise money in North America right now, it's very difficult to work with a lot of those intermediaries that are very useful, like the investment banks and whatnot. And to even open up a bank account to be able to handle the money for the crowd raise, to get a broker-dealer who's willing to settle the payments because they're scared about federal loss. But if you're accepting cryptocurrencies, you can crowdfund your cannabis business, for example. So that's one example of an area. Things that are outside of the norm, let's say, and that's one part of it that it really benefits the unbanked businesses. Commercial banking, and then the other.
Aside from cannabis, give me an example of another unbanked industry.
Well, I mean, and anything where it's difficult to get a banking relationship. So even a cryptocurrency exchange would fall into that category, right?
Anything that's touching a crypto asset.
So that's one, and then again the other that's even more important is it opens up a whole sea of investors for you overseas that would not have existed. And it becomes a lot easier to reach those people. So that's one real solid, tangible benefit of this whole environment, because now you have a whole crowd of people overseas who people like our teams and Georgia's teams and whatnot have very good connections with from the ICO world that they can sell to now, right? So that's
Georgia,
I just want to hit on a point, because you kind of skirted over this concept of AML KYC, just assuming that people would do it because they should. Yeah. But that is one of the issues. Like, hopefully some of you guys, like the hair on the back of your neck started to stand up a little bit when you were like, oh, people from overseas can just invest cryptocurrency and things. You're like, oh, does that sound right? Because, yeah, it could be used for a lot of nefarious purposes, right? Which is why responsible companies that are trying to raise money make sure that they conduct AML and KYC procedures.
And AML,
on
KYC,
all,
just in case anyone knows, money laundering and know your customer.
Exactly. So they're banking regulations, maybe not even necessarily applicable, but certainly best practices to this industry. And one of the things we pride ourselves at CoinList is being a compliant alternative. So if you want to conduct your offering in a compliant way, we'll help you with that. And just one of the really interesting things about working in AML KYC and helping these issuers is it's such a good way to screen out potentially fraudulent activity, because when you're issuing tokens, you're really building your network. Like, these are people that are going to be in your community. They're going to be using tokens and exchanging with you and really becoming a part of your business. And because we've been able to do AML KYC, we're able to screen out a lot of bad actors and things that you wouldn't want to be associated with. And so it has kind of a positive feedback loop.
When we were talking earlier about sort of the international aspect of this, you said something really interesting, which was this idea. I mean, for anyone who's been following crypto, you'll know that there's a lot going on in Switzerland.
Right.
And there was this idea that if you set up somewhere else, then that would give you like extra freedom to do things. And that's really actually come back to smack some people in the face. Could you just talk a little bit more about that experience? And maybe just a little bit more generally about some of maybe the bad advice that some of the entrepreneurs in this space have gotten?
Absolutely, and I really want to get Perianne's thoughts on this as well. But for a long time, we were hearing about issuers setting up in Malta, Switzerland, Gibraltar, these...
Now Panama.
Panama, these like
regulation.
crypto-friendly jurisdictions. And so, these issuers were seeking outside counsel, setting up these elaborate entities, and then realizing that the locus of the entity makes no difference. It's where you're trying to raise money. So if you want to target US investors or EU investors, you have to abide by US securities laws and EU securities laws and UK securities laws. So they just spent all this money thinking they were escaping jurisdiction to find themselves now having to comply with all these multiple sets and having a foreign entity trying to do it. I mean, we've had several instances where these companies that set up foreign entities had to then drop a US subsidiary just to be able to take advantage of US securities laws because they wanted to target US investors. And then once they get that money, they can't expatriate it out to the parent company. So it's a huge mess, and all of those attorneys and other people, advisors that told these issuers that they should be incorporating offshore are just should be shot. And that's also just to dovetail into this is why I was like, I hate lawyers. And like I said, I am a lawyer. But a lot of these lawyers also were the ones giving advice saying, oh, these are tokens, these are not securities. You can go ahead and offer these to retail investors. It's fine, it's not a security, it's just a product. Even if they had no, as Perianne was mentioning, even if they had no network built, they had nothing to actually use the token to do. They actually didn't even have a token. They were issuing it on a futures contract, basically, for a token in the future. And these advisors were telling them, yeah, those aren't securities. Go ahead, offer them, no big deal. Well, 800 subpoenas later, you can see the mess we're in. And look, I blame the issuers to a certain degree, but those issuers that actually sought out guidance and paid, like you were saying, paid hundreds of thousands of dollars for legal counsel, those people should receive some subpoenas.
They really should, and I think they are actually right now. And right now there's a lot of good exchanges and issuance platforms coming out. We ourselves, BLOC is our ticker symbol. We invested in ATS in New York and a security token platform that we're launching called Hyperion. CoinList is obviously an amazing one as well. And there's a few of these popping up, and my recommendation is that you really try to use these if you want to do a crowdfunding offering. And if nothing, what we're seeing is that crowdfunding is moving to offering secondary markets, whether it's lending platforms or crowdfunding platforms or the kinds of stuff that Hyperion and CoinList are doing. I think that's really where the space is moving to, and you're going to have a lot of private equity that's going to become a lot more liquid because of that over time. It's not going to happen overnight, but it will. So there will be some changes there, and the space has grown up. Look at these platforms.
There's kind of two sides of the international argument. In the United States, we're really at a disadvantage in the way that our government is organized because it's very fragmented. You have the SEC, the CFTC, FinCEN, IRS, and the list just keeps going on. And a lot of other jurisdictions, they're very streamlined. For example, in the United Kingdom, you have the Financial Conduct Authority, which is really a one-stop shop for everything financial related. So you don't have to go back and forth between all these different agencies who don't coordinate or even like each other here in the US. Or in Singapore, where you have the Monetary Authority of Singapore, which is even more centralized than the UK because it's the finance and bank regulator, and it's also the central bank. But it is a one-stop shop. So companies, and fintechs in general, have been able to get to market a lot sooner because it's a much easier process to get the regulatory clarity or approval you need to bring a new and innovative product to market. And that's really worked against us in the United States. And the data shows, in our report, we have a graph that shows where money is being funded from and in what countries these projects are being domiciled. And when you get to the United States, the trends reverse. So in the United States, there's a lot of foreign money being invested, or there's a lot of domestic money investing into domestic token sales. But the trend is the opposite with foreign money, where there's very little domestic money that has the opportunity to invest in foreign products. And that's the reason that Georgia mentioned, because if you are an investor in the United States, you're subjected to the SEC's laws. And there's other projects that are able to get to market quicker. Some is regulatory arbitrage, but there are quality projects overseas, and they're just blocking out US people, where they're just, you're not allowed to invest in their platform, not allowed to use any of their products because we don't really know what the laws are and they can't figure them out. And it's too expensive to get the legal guidance or opinions, or law firms are unable or unwilling to provide opinions to give that clarity. So part of us is also holding us back as a country to being able to participate in innovative projects overseas. And part of it is because we're very unorganized from the federal government's perspective, and there is no leadership in terms of what is the plan for blockchain in the United States of America. If you talk to every different agency, you're going to get a million different answers. Everyone is marching in their own direction, which is really irresponsible because blockchain is a very exciting development. People all over the world, most well-respected technologists, investors have recognized this as an important potential, similar to the internet, but there's no plan. There's no plan on how we're going to do that, how we're going to have responsible innovation that protects us from these issues that we've been talking about, but that still does not stifle innovation and investment in jobs and economic growth, which is what we're doing today.
Is there a hunger to do that and just no coordination, or is it residual skepticism about the space in general?
So a big issue, well, one, and I don't blame the regulators because I believe they're doing their job, and we spend a lot of time with these people every day. They're public servants. You know, I formerly used to work in Congress, so I know what it's like to be a government employee. They're doing their job. They're applying the laws that they're supposed to enforce the best that they know how. The issue is really at the higher level, where the President of the United States has never even said the word blockchain, at least not publicly. He's never tweeted it, which may be a good thing. But there's really just a lack of anyone within the administration that's even acknowledged this. And so the agencies are all just left kind of off on their own path, which is leading to mass confusion.
Okay, we have about 2 minutes left. I'm just wondering sort of quickly from each of you, if we did this panel again a year from now, like what do you think would be the main thing we would be talking about? Where are we headed in the short term? I'm going to start over here with Sean.
Well, I think what I said, you're going to see more liquidity in the space. You're going to see more of these second markets associated with crowdfunding platforms of various kinds, and that's going to be a good. I don't think it'll ever be as big as it was before. Like you're not going to see raises like that, obviously, and there's no reason why people should expect that. You're not going to have You'd be lucky if you have a hockey stick growth, and if the company is actually doing something and is positive and gaining users and whatnot. And overall, it's a benefit. Yeah.
Yep, I concur with the secondary market piece. Like, I think we're going to see a lot more exchanges. These tokens are going to start to be issued. We're going to start seeing the functionality. I'm really excited for a lot of the projects that we've worked with, and some of the others that I've seen that are actually going to start going live and having users, and we're going to get to see the fruits of their labor. And then I'm hopeful, cautiously optimistic that we will get some sort of government consensus around just simple things. What is a utility token versus what is a security token? I'm not asking for much, but having a little more clarity and guidance from our regulators would be helpful as well.
So I'm incredibly optimistic. I think we will see a wave of institutional money enter this space. There's been a lot of institutional money that has been sitting on the sidelines, mostly because there's not protections in place for the institutional investor, custody being one of the biggest issues. Over the past several weeks, we've seen many different very well-respected companies come forward with custody solutions, and those will be all rolling out in.
And just quickly say, when you say custody, that's just quickly define that for people.
So if an institutional investor wants to invest in crypto, they want to buy Bitcoin, they want to buy Ether, they want to buy whatever crypto token, they're likely not going to take custody of that themselves. They just don't do that. They want a custodian, a qualified custodian to do that for them. Today, there's been very little.
And that's because that's essentially like holding a lot of cash, kind of.
It's a huge risk.
Well, and it's
for
a
them to
regulatory
take on.
requirement for an investment advisor. You actually aren't allowed to hold it yourself. You have to engage a qualified custodian.
And we're just now starting to see qualified custodians being able to offer products to the crypto community. Those are just starting to happen like right now. It's just 2 weeks ago, Fidelity issued their announcement that they will be offering a custody solution for crypto. So I think that will enable a whole nother wave of investment into the space that we haven't seen before. And there was also the Yale Endowment Fund just released the information that they were invested into a crypto-related portfolio. So that was kind of I think the tip of the iceberg of the next set of institutional investors that we will begin to see enter this space. So I think the prices of the crypto industry will increase over time, but you're also going to continue to see a lot of the fraudulent projects continue to dissipate.